From New York City for our viewers worldwide, I'm Scarlett Fu. Bloomberg Real Yield starts right now. Coming up, a Fed falling in lockstep to support the labor market despite the absence of official data. A quick warning about cockroaches puts the credit market under a microscope, triggering a flight to safety and sending Treasury yields lower. We begin with the big issue, the Fed's next move.
To a certain extent, we are flying blind right now.
Macro dynamics are still a little bit unclear.
We're trying to look beyond the noise.
We have a slowing in terms of the economy.
We've got a tortoise of an economy.
I think you have a Federal Reserve that's assuming the inflation is more temporary than the labor market.
There's no doubt that there is weakness in the jobs market.
The weakness in payrolls is ultimately why you're getting rate cuts.
It gives them kind of a free pass to take the cut here in October.
With the Fed's focus on jobs, they continue. They cut 25 basis points in October.
They want to make sure that they are achieving still full employment.
The market, of course, is pricing in a very aggressive path of cuts between now and the end of next year.
It's not entirely clear what would catalyze the Fed to change its view.
We've got a Fed that's going to cut.
The two-year yield is the best crystal ball on Fed policy, and it just told you that the Fed's going to have to act more aggressively.
There's going to be more discussion around the December meeting.
You heard investors singling out the two-year yield. Here it is, set to decline for a third straight week and holding near the lowest in 3 years, going all the way back to September of 2022. There was, of course, yesterday's pivot to risk-off mode across the financial markets and more Fed officials singing from the same dovish hymn book. Fed Governor Chris Waller said rates can continue to decline in quarter-point increments, while fellow Governor Stephen Miron lobbied for a bigger cut. Traders have now settled on two standard cuts this year, one on October 29th and the second in December. The big debate is whether the Fed keeps that cadence up next year or moves more cautiously. Regardless, it's clear that this Fed is focused on the labor market.
Labor market risks do appear to be increasing, not outrageously, but noticeably. Over the rest of the year, I view easing along the lines of the median SEP policy path as appropriate.
As long as we see the labor market and other factors, economic data evolving in the way that I expect, that we'll continue to be on a path for lowering the federal funds rate.
You don't want to make a mistake. So the way to avoid that is to go, cautiously or carefully and do 25, wait and see what happens, and then you can get a better idea of what to do.
There really isn't a risk-free path now since it appears that inflation is continuing. But now the labor market has demonstrated pretty significant downside risks as payroll jobs have declined.
Let's dig into all of this with Steve Brown, CIO of Fixed Income at Guggenheim Investments, and Priya Misra, Portfolio Manager at JPMorgan Asset Management Core Plus Bond ETF. Priya, let me start with you because you observe that there appears to be a disconnect between the labor market and GDP. Walk us through what you mean.
Sure. So if you look at the GDP numbers, or even I would say consumer spending, you'll say that's fine. So why is the labor market weak, and what should the Fed focus on? I'll say the Fed has its dual mandate with the labor market more important than GDP. But I would also say let's look at GDP and look under the hood. Really, it's an AI trade. If you take out AI-related investments, GDP is running about zero. So I think, we're in a government shutdown. We're not getting real-time government statistics. But if you take a step back and look at the data, the economy is slowing. Now, it might be slowing into the soft landing 1 to 2% GDP, but the labor market is slowing. And it might be a structural reason because of AI, or it could be that companies are paying for tariffs through reduced hiring. We still haven't seen the pickup in layoffs. I mean, I do miss initial claims, but looking at the state data of initial claims, we're not seeing the pickup in layoffs. So I think the disconnect, if you were to take out the AI effect, there's less of that disconnect. Things are slowing, allowing the Fed to respond to the weaker labor market, to cut rates at least to neutral. And that's what the market's pricing in. The market's not pricing in aggressive rate cuts below neutral. The end point after all those rate cuts is still around 3%, which is most estimates of neutral. So I think the market, every market is priced for perfection, priced for that soft landing, slowing growth, Fed allowing the Fed to cut rates and not anything more.
So, Steve, you observe that it's a low-fire, no-hire labor market, and certainly the private data backs that up as well. What is your take on what traders are pricing in terms of rate cuts, not just for the rest of this year, but in 2026?
Yeah, as Priya said, the market's coalesced around a 3% terminal Fed funds rate.
which largely aligns with our base case view. I would add, though, that we think there's downside risk to the policy rate, particularly as Priya laid out with what we think an underlying weakening or softer than expected economy. So as interest rates start to fall, that will start to feed back into economic growth, we think, and eventually be a ballast and supportive for growth. But for now, with the Fed focused on labor market weakness and not wanting to be above neutral, we think that it's going to be a pretty equal step down towards 3%. We have to think, too, the Fed leadership, there's going to be a substantive change here in the first half of next year, and we know what the bias of that policy is going to be.
Yeah, pretty clear, and that is lower rates for sure. Priya, what happened to the debasement trade? It was such big talk over the last 2 weeks. The dollar set for its worst week in more than 2 months this time around after rebounding last week. But, Bitcoin is sliding, and it doesn't feel like people are trying to run away from U.S. assets. Treasuries, for instance, are playing the safe haven role that they've long played.
Exactly. Great point. I think this is the big difference from April. When we had the risk off, it was mostly trade, and now we've got some trade. We've got these credit cockroaches, as we're calling it, or the cockroach wars. But rates have done, government bonds are behaving the role that they should play in a portfolio. I think it's the revenge of diversification is what we're calling it, where making sure you own some duration, high quality spread product, if you've got risk assets in the portfolio. So to your question, what happened today? I think, there was all this fear around the sell America trade. We didn't see the sell America, we saw the hedge the dollar to the extent that investors were over-invested in the dollar or their dollar allocations had gone up. I think what we've seen in the last few months is that dollar exposure has been hedged away somewhat. But I think when we look at auctions, you look at general foreign demand into even corporate bonds, mortgage bonds, it's remained strong. So I think you look globally, the US is still the best performing country growth-wise. And, I think the trade war, it's a China on-off. I think we're talking about what's going to happen, what's the off-ramp with China. We're not sort of with the whole world. We're not decoupling from the rest of the world. So I think some of the fears of April are behind us, and that's why this feels different. Bonds did what they were supposed to do. I think it's telling you, I'd agree with Steve. I think if you own some bonds, even though the 10 years now back at 4%, there's still room. If you have risk assets and there's a further slowing in the labor market, the Fed can cut more aggressively. You were talking about 50 basis points. That's not what we're calling for, but can I see that? Absolutely. If we get the labor data and we realize, it's actually slowing much more, the Fed can cut more aggressively, and I think rates will remain that ballast or will play that ballast role to the portfolio that they have played in the last few months. I think that'll continue because the Fed's shown its hand, and this sell America debasement, I think gold, should central banks have owned some gold? I think that was more a supply demand of central bank reserves rather than people just leaving the U.S. asset class.
Right. We look at the 2-year yield at the lowest in more than 3 years, Steve. The 5-year yield sinking to 3.5%. The 10-year yield falling below 4%, the lowest since early April. If you're going to buy bonds, where do you want to be on the curve?
You want to be a little bit more mixed now. I think longer term, we still expect the curve to steepen. Priya highlights that the lack of the flow through in the data, frankly, on the sell America trade. It hasn't happened. Some of the data we will actually get is later today, the latest release from the Treasury, the tick data showing foreign flows, which we expect to again be positive. We're seeing them as positive through our franchise. So we're seeing pretty balanced demand across the curve. New issue supply is being digested. There's still strong demand technicals, especially in high-grade credit. So we're still biased for a little bit of a steepener, but we've expected a range-bound level for interest rates. When you look at the 10-year, we broke through 4%, as you said. That, to us, was a mini signal to reduce a little bit of our duration and flatten out exposure a bit. But we still think bonds provide upside participation if you get some risk off elsewhere. And then they have a still high level of yield, and yield's the biggest predictor of future returns.
Yeah, and so you've recently reduced some duration, Steve, but Priya, you like duration.
We do like duration because we've been adding to risk. In pullbacks, as we add to risk, I think owning some duration, and particularly if you can be in the 5 to 10 year part of the curve. Remember when the deficit was a big concern, and structurally it's still a concern, but the tariff revenues are improving the deficit picture. And so I think just, wobbles in the very front end makes us a little nervous with SOFR rates starting to pick up. Bank reserves have come down to close to neutral levels. That's why I think owning some duration, if you've got credit risk in the portfolio, I think makes sense. So we're holding on to our duration.
We're going to talk about credit risk in just a bit. But Steve, before we let you go, I want to get your take on the one official data that we will get next week, and that is CPI. How are investors, how is the market positioned for that?
I think it's a secondary consideration for now. The market's being driven by labor market potential imbalance. We're obviously not getting data there. It will be helpful, but with how trade policy, tariff policy is evolving, and frankly, our view that you should continue to see disinflation absent any noise there, which is mostly showing up in the goods section. We don't think it's going to be a market-moving event. The Fed seems predetermined for now to get back towards a neutral state, and that's because of the state of the labor market, less so on inflation, which they still don't know how to think about medium or longer term.
They still don't know how to think about it. I like that. Steve Brown, thank you so much. Steve of Guggenheim Investments and our own, well, I say our own because I like seeing her around the office, Priya Misra of JPMorgan Asset Management. Really appreciate it. All right, coming up next, the auction block. Credit concerns spread, and that's, of course, on the back of disclosures from two regional banks. And JPMorgan Chase CEO Jamie Dimon warns investors that more credit problems are likely to emerge, saying, when you see one cockroach, there are probably more. We talk credit next. This is Real Yield on Bloomberg. I'm Scarlett Fu. This is Bloomberg Real Yield. It's time now for the auction block, where we highlight the global debt sales for the week. In U.S. high-grade sales, the Columbus Day holiday, combined with uncertainty in the markets, slowed down the pace of deals. We did have sales from the big banks, Goldman, Morgan Stanley, and JPMorgan. Morgan's is a rare Friday offering. Goldman's deal was its largest investment-grade sale since 2022. They were not alone. In Europe, Citi posted a $3.2 billion sale of 5-year and 9-year euro-denominated notes. And back here in the U.S., Bitcoin mining company TeraWulf making its debut in the high-yield market. It is the first crypto company to sell debt for data center expansion. It saw strong demand with orders of more than $10 billion. The big headline this week in credit was JPMorgan CEO Jamie Dimon's remarks in the wake of the First Brands and Tricolor bankruptcies, which revived concerns about complacency. He said, quote, "We scour all process, all procedures, all underwriting. I probably shouldn't say this, but when you see one cockroach, you will see more. Everyone should be forewarned on this one." This, of course, sparked debate in all corners of the credit industry, public and private.
Jamie, I think when he refers to cockroaches, I mean, he can speak for himself, but he's really trying to keep us and everyone else on their toes. And you're starting to see things that feel late cycle. And I would feel quite strongly that we're in the latter innings of a credit cycle. The problem when being in the latter innings, you don't know if you're in the 6th inning or the 9th inning, and no one will ever know until afterwards. Just being a lot more cautious in how we think about credit.
So I guess he's saying there might be a lot more cockroaches at JPMorgan, or I'm not sure I know what he's saying. I mean, it's not a private credit issue. I mean, it's a liquid credit market. There will always be bankruptcies. There are thousands of credits in the marketplace.
Let's dig into this with Meghan Graper, Global Co-Head of Debt Capital Markets at Barclays Capital. So, Meghan, we also got this week Zions and Western Alliance disclosing that they were victims of loan fraud. For at least one day in equities, it was very much sell first and ask questions later. How's that concern showing up, or how did it show up in the credit market?
I think what we're seeing is quietly a decent amount of resilience in the investment grade credit market. And so, when I look at the backdrop, there are some idiosyncratic situations out there for certain. But what we're seeing is actually things holding up incredibly well in the upper echelon of the credit markets. And why is that? It's technicals remaining, I think, very firmly in the driver's seat. And so we see that with all-in yields continuing to attract cash. We've had 24 straight weeks of inflows into investment grade. That's a dispersion relative to what you're seeing in high yield, where there was actually an outflow this week. But when you talk to investors, hedge funds, asset managers, insurance companies, universally what we're hearing is that they expect continued inflows for the better part of the next 6 months. And I think more importantly than that, it's the yield that is driving it, but consistently what we're hearing is that it's 75 basis points that yields would need to fall to see that bid start to erode. So I think bottom line, things are holding up incredibly well, and it's really isolated to a few handfuls of events.
When there is a blow up in credit, does that lead to people gravitating more towards the safest credit like investment grade? And I ask this also because I noted that Zion and Western Alliance, they're rated investment grade, at least for now.
They are, but they have a de minimis amount of debt outstanding. So it's a couple billion in the context of a multi-trillion-dollar market. So I think we've isolated and contained that exposure. You saw, maybe 2 to 3 basis points of spread widening in some of the regional banks, which is, I think, indicative of positioning in the market being cautious rather than defensive. Investors are certainly picking and choosing their spots, but we're seeing no signs of concessions creeping higher for the deals that did come to market this week. And as you suggested at the onset, deals are meeting record size with massive oversubscriptions, which just tells you there's a flight to quality in investment grade, and that's pervasive.
And the deals that came in this week, of course, are the big banks that have reported. They do this every quarter, right? They report their results and then they issue debt. And these are actually coming in at very tight spreads, leaving investors exposed if there is another problem. If you look at this chart, here's the spread between investment grade banks and the rest of investment grade. It's pretty much flat right now, but you look at mid-2023 during the regional bank crisis, and it widened to about 30 basis points. No question that the big banks are doing great, but I wonder, is this the top, perhaps? Is the ground starting to shift for investors who are long bank bonds?
We're actually seeing a propensity to think about spreads moving tighter, not wider here. Why is that? It goes back to this fundamental concept that technicals are overwhelming. And so the supply-demand imbalance that exists, actually looking at headline numbers, there's a lot that's been made of how sizable gross supply has been this year. And a lot of that, as you say, has come from the bank sector. In fact, I think close to 90% of this week's issuance has come from self-funders, the big six. At the end of the day, there's cross-currency arbitrage happening. So the dollar market isn't the only game in town. Citi being in the European markets, there have been about a 40% growth of opportunities in euros and sterling from U.S. companies taking advantage of liquidity there. And equally, you're seeing banks like Rabobank successfully pricing a 3-year last week in the dollar market. So there's cross-pollination. There's a global subset of investors that continue to show up. And we think the bias as we move towards the year-end is actually spreads moving to the mid-60s versus 77 on the index where we stand today.
So last week, Jeffrey Sherman of Double Line Capital talked to us about credit concerns here on Real Yield. And here's what he said. Take a listen.
It's emblematic of excessive risk-taking. I mean, that's really what this embodies here. And we can blame due diligence. We can blame massive concentration. But at the end of it, this is what happens when people chase yield. You never thought we were going to be talking about a spark plug manufacturer and someone who creates like windshield wiper blades is going to bring down the system. Is it contagion? It's too early to say that that's the case. There's some big numbers here, but they're absorbed in larger funds. But I think it's emblematic of the risk-taking environment that we've seen.
He talks about the risk-taking environment, and I know that for so many analysts, and the latest results from regional banks today really make clear that these were one-off or idiosyncratic events. But they do raise some alarm bells over the underlying credit quality with massive funds chasing assets with perhaps lighter focus on risk management. It's also reasonable to ask, Meghan, why are all these credit one-offs, idiosyncratic events, seemingly occurring in a short period of time?
Well, that's a great question. I mean, I think we're getting earnings season, so there's a naturally more information flow that's coming out and disclosures that are publicly made and create opportunities for investors to do diligence and then choose where on the curve and what subset of the market they actually want to deploy cash. Because as we said, there's a sizable amount of cash. There's both coupon income, but there's record COVID debt maturing this year, which means a natural rotation and reinvestment of that cash into the market. So it needs to find a home. It needs to be selective in terms of how it's doing it. And I think disclosure is a key part of how investors are making those decisions.
All right, well, we'll continue to see how things shake out as earnings season rolls on. Meghan Graper of Barclays Capital, thank you so much. And if you can't get enough talk on credit, please check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. This is Bloomberg. I'm Scarlett Fu, and this is Bloomberg Real Yield. Let's go now to the IIF meetings in Washington, where Bloomberg International Economics and Policy Editor Mike McKee is speaking with St. Louis Fed President Alberto Musalem.
Into the meeting after the next. Well, you mentioned tariffs, which is sort of the story of the year. How much inflation do you see at this point feeding through, and are you anticipating a lot more coming through, or have you been surprised by where we are?
Our team in St. Louis has done an amazing job of trying to understand this. And what they've done is they've looked at realized tariffs as opposed to statutory tariffs. So what companies are actually paying at the border rather than what the statutory levels are, because that already takes into account changing of trade patterns, negotiations with suppliers abroad, all that. So what they've come up with, and I've gone through the numbers with them, and I have confidence in them that the impact on headline and core inflation on the price level is expected to be about 9/10 on headline and 8/10 on core. That's the total impact. So far, our understanding is that about a third of that has occurred, and the other 2/3 probably will happen in the next 2 to 3 quarters. When I look at the current inflation rate, it's running at about 3%, plus or minus. About 2 to 3/10 of that, so 10% of the current inflation rate, is attributable to tariffs according to the numbers that we have run. If you don't like it that way, you can say inflation is running at 3, so it's 1% above target. 30% of that excess inflation can be attributable to tariffs. My own expectation is that tariffs will work through the economy for the next 2 to 3 quarters, and by the second half of 2026, that will have finished, and inflation will then return to a convergence path towards 2%. But there's risk to that view. I get to speak to a lot of CEOs and some very large retailers that have national and global presence.
That was St. Louis Fed President Alberto Muslan speaking with Bloomberg's international economics and policy correspondent Michael McKee. And we will keep you posted on any headlines that are generated from that conversation. In the meantime, we are looking at a stock market that has settled on a direction, at least for now. It is higher with the S&P slightly firmer, but let's look at what's going on in the yield picture right now. Yields are moving higher right now, coming off some lows that we reached yesterday in the overall risk-off move because of the regional bank disclosures. You can see the 2-year yield up 2 basis points to 3.45%, and the 10-year at 4% even, up 2 basis points. This is real yield.